Hello, and welcome to Season 3 of Fractional Futures. In this season, we're diving into how fractional CMOs can help SMEs and portfolio companies scale and maximize enterprise value. Joining me in every episode is Rob Nicholls, a seasoned CFO, non-exec director, and board advisor with over 35 years of global finance expertise. Rob specializes in profit maximization and value creation, and I'm delighted to welcome him to the show today. Hi, Rob. How are you doing?
Good to see you again, Paul. Thanks
What
for
have you
the
been up
invitation.
to? Where have you been golfing this week?
Playing a lot of golf, actually. Played Friday on my own, actually, but it was all good. Weather's a little bit dodgy at the moment, but we'll try and get out this afternoon.
Yeah. Did you knock any hole-in-ones playing on your own, or?
I did a lot of mulligans, actually.
Fantastic.
Do-overs.
So, Rob, let's get into the meat of it today. This episode really is looking at what investors, maybe what CFOs would do when assessing the marketing health of a portfolio company to see if it's got the right credentials to take it to the next level of growth. But when I've spoken to investors, either VCs or private equity, I always ask them, I always push them quite hard on how deep they go when they look at the marketing capability. And I've always been surprised they don't go as perhaps deep as I would expect. When investors assess a company, they're very meticulous with examining the financials, but marketing is often overlooked. They might look at a very high level marketing KPI, but they perhaps don't look at the strategic capability of the organization. The organization might not have a marketing leader in place. The marketing might be left to the founder or the co-founder, but are the investors looking at their capability? How do you go about assessing the marketing function?
So I think any acquirer is going to look and do their due diligence. I'm a believer in that most due diligence is nowhere near sufficient to uncover the skeletons in the closet, if you will. And you're right to say a lot of the due diligence is going to be around the financials, the management accounts, the recent period management accounts, and any statutory accounts that have been filed. But that really doesn't tell you very much because it's all about the future. It's all about where the business is going. So focusing too much on the financials probably is a mistake, and not focusing enough on the marketing capability, where the industry is going, where the opportunity is going, is not focused on sufficiently. Now, marketing, to be honest, in a due diligence, in a venture capital or a private equity, they will look at it, but they won't look at it with the microscope that they probably should apply to it. There simply isn't the timeline. So they are really looking very, very quickly to get a sense of where the business is going. But more especially, a lot of private equity or venture firms, they're investing in the founder, they're investing in the CEO and their vision for that business. So to be honest, where it's been is kind of irrelevant. It's where it's going to go. And if the founder can spin a good story about what the opportunity is, that will often suffice as the due diligence for the market opportunity. There won't be a lot of discussion around the TAM and the SAM and the pricing and recurring revenue on a monthly or an annual basis. There just isn't the timeline around that. But they do believe in the story that the founder or the CEO can tell. And that largely will be a case of that is the extent of the due diligence about the market opportunity, other than looking at the financials. Okay, you turned over a couple of hundred last year. You may be going to do 2, 3, 4 million this year. It really is a finger in the air kind of job. Nobody knows. Nobody's going to be right. And it really is down to the CEO and the CFO to spin the story to the investor company that this is the market opportunity and that we've got traction and we've got a product market fit, and here's the market opportunity, and here's the team to take it forward. Really, there isn't very much market research. There'll be an understanding of what the product or service is. Beyond that, it's limited. It really is limited. So unless you're talking about a 50 to 100 million pound a year recurring revenue business, there really isn't the greatest amount of due diligence, and they don't expect a full-time marketing person in the business. And even if there was one, they're likely to be a relatively inexperienced junior member of staff that's perhaps doing some social media and some blogs. there isn't likely to be an experienced, knowledgeable, insightful CMO or marketing director that's done this 1, 2, 3 times. And again, the acquirer will be leaning quite heavily on board advisors and non-execs to add the perspective of what the opportunity is and add the marketing or sales and marketing insight to the acquisition.
I think certainly what I've observed in portfolio companies and speaking to investors and the founders, particularly founders, several founders will say, I'm going on this on gut instincts. I've got a good feel for the market. I've got a good feel for what my product or service provides. That for me is a red flag. I think if you're running a business purely on gut instinct and intuition, especially in the marketing domain, you're sailing into choppy waters. Businesses that rely on that gut instinct for their marketing, if they can't provide any data-driven insights around total addressable market, customer segmentation, demand forecasting, it creates a whole world of uncertainty. And especially for a potential acquirer or an investor going into that business, it creates a lot of unknowns. And I think if you're facing that, I think that for me would be a warning, and that's kind of a level due diligence that investors really need to be looking at. What data are you using to drive your assumptions or your founder story? How, in your experience, Rob, have you seen that where there's been businesses where you've got a particularly personable founder or CEO, they might have great gravitas, they might be great in front of a camera, great at spinning a story, but they might be over-egging their own gut assumptions on where the market really is at?
I mean, a lot of due diligence for any acquirer is about risk reduction. And any time you can reduce the risk in an acquisition or acquiring any business, you're going to be onto a positive thing as well. But it does come down to an awful lot of acquisitions, whether you're turning over less than 1 million, 10 or 25 million. An awful lot of the acquisition is going to be predicated on the storytelling that the CFO and the CEO can put into the marketplace, can put into the mind of the acquirer. And so due diligence on behalf of the acquiring company, you've got to get under the surface. You've got to understand, is there product market fit? Is there traction in the marketplace? How many times has the business pivoted? I'm working with a startup company that's pivoted 4 times in 2 years, and they still don't have traction. They're getting a little bit of revenue, but at some point, most acquirers, most pre or venture companies will recognize that you'll get it right. It may take you half a dozen pivots. It may only take you 1 or 2 pivots, but you're looking for evidence that there's traction, whether that's engaged customers, testimonials, clients that really love your product or service. That's what the due diligence a lot of acquirers are looking at is evidence, tangible evidence, testimonials, case studies, customers that just love your brand or your product. That goes a long way. Equally, the storytelling on behalf of the business and also the brand perception. What do people say about the business or the opportunity and where it's going? At the moment, there's an awful lot of interest on gaming companies, on online betting companies, if you will. People can see the opportunities. Venture firms can see the opportunities. It's a multi-billion-dollar opportunity. So any business that is in that world, there's an awful lot of due diligence going on around acquiring small online betting companies, whether they're specialist companies, acquiring them and rolling them up. There's value accretion in that. And an awful lot of people out there selling stories around, we know this market, whether it's a certain sport or whatever it may be, and the market opportunity is X. That's something that you can get your hands around and quantify. But equally, you've got to have metrics around this, and a lot of metrics are kind of superfluous. They don't really mean a lot, and it is what it is. Customer acquisition costs. There's an awful lot of that you can package under that, and there's an awful lot of costs that you can exclude from that as well. So metrics don't mean as much as some people might think. A lot of it comes down to gut feel about the market opportunity. Do we believe that this opportunity is going to scale 20, 30, 50, 100x? Because you have to remember that any venture-backed company is going to be looking for an exit, a quick exit, 2 to 5 years, quite possibly 5 to 7 years, most definitely. And they have to be looking at the opportunity being a significant multiple of the entry cost. If you're acquiring a business for £1 million, you're going to be looking for 15 to 25 million exit in 3 to 5 years, 5 to 7 years maximum. And the market potential that the CMO should be able to illustrate, or in this case, it's likely the CFO or the CEO that's going to illustrate, they've got to paint a picture of what the opportunity is. And just coming back to the point about due diligence, that's about reducing the risk, the inherent risk to the acquirer. So understanding what the opportunity is and really putting some metrics around that.
And that's probably a nice segue to talk about metrics, Rob. I think a lot of businesses will probably relate to this next statement, where they don't know if their marketing is working or not because they don't know if they're tracking the right numbers. With your CFO hat on, what marketing numbers are you particularly interested in to see the value of marketing and how it's creating growth for the organization?
So this is where we get into a little bit of a grey area in terms, this is where other functional areas, the chief revenue officer, are starting to impinge on the world that might have been owned by the CMO. So an awful lot of the metrics that I, as a CFO, or the board is going to be looking at are around the market opportunity and the revenue generation, the traction in the marketplace. So it's monthly recurring revenue, it's annualized recurring revenue, it's the customer acquisition cost. And for me, unfortunately, I'm a revenue generating person. I want to see revenue per employee. So if I can see, if I've got two companies, one's doing £100,000 of annual recurring revenue per employee, and another business is doing £1 million on an annual recurring revenue basis per employee, I know which businesses that I want to be involved in. Whatever metric you use, you've got to choose one, two, three, no more than half a dozen, certainly. But this is where marketing can lose control of the narrative, if you will. And this is where there is an opportunity for the CRO to step in here, or for the CMO to lose the opportunity to a CRO. And that I'm seeing more and more. The other costs, branding, pricing is less important at that point. It really is all about revenue and revenue per employee and monthly recurring revenue and annualized recurring revenue, because that's what investors want. That's what the portfolio company is going to be really looking over your shoulder. And the board observer that's sitting in on the quarterly or even monthly board meetings, they're going to be very, very closely attuned to revenue. And anyone who can talk to the revenue opportunity or the incremental revenue or the growth in revenue per user, per employee, is going to have the ear of the investor and likely the CEO and the CFO as well. So I'm a big believer in revenue-based metrics, often on an employee basis. So traditional marketing metrics, to my mind, are a little bit less important, certainly in the first couple of years. In later years, yes, they'll become much more valuable. But it is a world where the CRO is certainly moving into position here in an increasing way.
Yeah, you're right. And I think if you look at LinkedIn every day, there's noise from marketers getting frustrated with CROs elbowing into their space and vice versa. And I think certainly since digital marketing has become a big thing, digital marketing in itself is a very wide discipline. Having a whole load of digital metrics available at your fingertips to track campaigns, advertising spend, whatever it might be, it's great, but it's given us too much data to track. And I think a lot of marketers have got guilty of just presenting back vanity metrics our website has generated this number of impressions, or I've got this number of followers this month, or whatever. And it really doesn't go back to, what pound sign does that contribute to? CMOs, marketing leaders, they need to talk the same language as the CFO. As a marketer, if you're not able to provide insight into pricing power, competitive positioning, revenue expansion, then you're not talking in terms of margins, profitability, and enterprise value. You kind of have two different conversations. I think that's probably where a lot of CMOs and CFOs fall out of love with each other. That's where they talk in different languages. Is that something you see quite often? And if you do see it, how do you help coach or mentor a CMO who's perhaps talking in the wrong way?
So in the companies I advise currently, I have one CMO in that world. And to be honest, I do try very hard to not mentoring, but build a relationship with that person. I probably talk to that person as much, if not more, than the CEO, the managing director there as well. So I think you're absolutely right, is the CMO or the marketing lead, whether it's an internal person or an external person, has to talk in the language of the board, the CEO, and the CFO. And that generally is revenue, margin, and profit base. I'm a big believer in gross margins, is the dollars left after I've subtracted the cost of actually acquiring that revenue. So for me, gross margin is a key metric. And in all the companies, the portfolio companies that I work with, gross margin is tracked on a monthly basis. And that's a key metric for me. To be honest, followers, blog numbers, downloads. It's nice. It's nice to know that there's traction in the marketplace and that there's followers, but it doesn't generate revenue or profitability or margin. And so I think there is an opportunity for marketing leaders, whether they're CROs, CMOs, business development people, to really understand what metrics are really making it happen at the boardroom level. And that is sales growth, revenue per employee, gross margins and net margins, and EBITDA, bottom line net profit. Those are the sort of numbers we need to be talking of. The value of individual incremental users, additional users of the service, the market opportunity, huge number. If my business is only turning over 2 million, but you're telling me that the market opportunity is 50x that, why aren't we going after that? And what metrics do we need to understand, we need to implement to see that we're making incremental progress on a monthly or quarterly basis? Because if you're not showing incremental improvement on a monthly or quarterly basis, you're not going to be in place very long. You're not going to be the CMO or the marketing director very long if there's no growth in revenue per employee, or annualized recurring revenue. You're just not going to be in place very long. What is the average tenure of a marketing manager these days? About 18 months now. It should be a lot longer, but the timeline isn't there. The opportunity isn't there to build this brand unless you're working with a family company that perhaps is thinking in terms of decades. Most businesses certainly aren't these days. And the timeline, the funding timeline, the cost of capital today, they have to understand you've got to generate revenue and margin, gross margin, quickly on a recurring basis in order to invest in other things, people, new innovations, in new iterations of the product or service, new people to do other things. That's what it's all about. And I think there is an opportunity for marketing to understand better what the key financial metrics that the board, the CEO, and the CFO really want to hear about. And it's about revenue, unfortunately.
And there's been several clients that I've gone to, and one of the very first things I look at is the tech stack to see how easy it is to measure, monitor, and extract those metrics. Quite a lot of companies, they do struggle with metrics and tracking. So for those marketers that are going into a business and it is difficult to get those KPIs measured or out of a system, how can the CFO and CMO work together to quickly build the reporting metrics, just maybe for day one, just to get things spinning up?
So again, there are numbers available, and marketing needs to be party to those numbers. They need to be have shared with them the strategic plan, the monthly numbers that come out of Zero or QuickBooks or Sage or whatever financial system. They should be made. And a lot of times the finance department, the finance leader will often hold on to those numbers. They might not be quite so willing to share them with the marketing person or the business development person. And that's something you've got to get over. And you're going to get over that by building a relationship, not an adversarial, not a confrontational relationship, but a really working together for the benefit of the business and helping to support the CEO and understanding the narrative. So a lot of it comes down to the relationship you build with the finance leader. So it is incumbent on the marketing person, whether it's CMO, internal, external, fractional, or otherwise, to build a relationship. You've got to understand what makes the finance leader, the CFO, and the CEO tick, because believe me, the CFO knows what the CEO is thinking, and it knows what the board is wanting as well. So they are a real opportunity for you to understand where you fit in the business. And I come back to, again, the numbers are all there. The data is there. How you choose to share it, and if it's shared with you, that's up to the relationship that you form. I'm a big believer in not having too many metrics. I think I've been at companies where they've had 15, 20 KPIs and more, and they'll have KPIs, different KPIs per business stream. I'm a big believer in having a dashboard of perhaps half a dozen metrics at most, and most of them, 3 probably out of 6, have to be dollar or pound revenue based metrics. And probably the other 3 metrics are things like gross margin, numbers of customers, and maybe one other metric as well. Too much is just too much. You don't. The board doesn't want to have more than 3 or 4 or 5 or metrics. They just don't want to see that. They want a very high level summary. What is the growth in the last month or quarter? What is the gross margin? What is the trend in gross margin? What is the customer acquisition cost? Is it going down? What are the total numbers of customers we've got? What is the churn? How many of our existing customers, if we've got 100 customers, are we losing 10 customers a month? In which case, are we turning over the whole portfolio of clients annually? They want to get an idea of the trend in those numbers. So the trend, I'm a big believer, is the trend is your friend unless it isn't. So understand where these things are going. Is the market opportunity increasing? Is it stable? Is it declining? If it's declining, what are we needing to do about it? Where are we looking where the market's going? What is the opportunity? And the marketing, business development, CRO, CMO needs to be informing the CFO and the CEO and the board where things are going. Where do they think the business opportunity is going, and advise accordingly.
Actually, that probably is a great segue into this last segment. Any strategic marketer, any marketing leader really needs to be part of the eyes and ears of business to look at the market. Where are the trends? Where are the opportunities coming from? What are the threats in the marketplace, and how do we mitigate that? Several marketers, they will find opportunities and they will come to the CFO with their cap in hand, begging for more money, more budget to do the next big campaign or the next big activity, whether it's a brand repositioning activity, a brand identity change, something like that. How do you respond to those marketers that come to you wanting more budget to do something, and you can't really quite see where the value is coming from? How do you navigate that sort of difficult conversation?
What goes a long way is credibility in the company, credibility with the CFO, the CEO, and the board. If you've got credibility, you're going to get listened to. Second point is the relationship. Do I believe in you as a marketing leader? Do I believe in where you think the company is going and the opportunity is going? If I can plot the revenue number on our strategic plan, and I can plot it on a curve and see where the industry is going in the next 2, 3, 4 years, and I agree with you, you're going to be on a positive uptrend. Coming to me for 25, £50,000 extra is not going to happen unless I can see there's an opportunity to engage in growing the business. There's an awful lot of red flags. You know, a lot of businesses, they'll keep going down one road and they won't change, they won't pivot, they won't recognize that a market opportunity that they thought was there just hasn't come about. I've got a business that I work with currently that has been plowing a field for the last 2.5 years, hoping that there'll be a pot of money that their customers can dip into, and that hasn't come to pass. But we've invested an awful lot of money, hundreds of thousands of pounds, in people, systems, and the opportunities, but the revenue has just not come about. And so that's one of 4 revenue streams that I, as a CFO, have been saying for over a year, we need to cut off and stop investing in that. So if I can't see a tangible pot of money or revenue opportunity there, you're not going to have my support. And it's a big risk, but it's also a red flag. If I can't see tangible engagement in that business, or with the clients that we need, or recognition in the marketplace that that's an opportunity, you're not going to get additional funding to go in that direction. You're just not going to. Most businesses don't have a chief risk officer. When you get to a large couple of $100 million business, you may have a CRO, a chief risk officer, other than the chief revenue officer. So effectively, the chief risk officer is the CFO. They have to be looking out for what is the tail risk, if you will. Where is the opportunity not going to be, and where do we need to clip our wings, and where do we need to expand? As a board member, the CFO is a custodian of capital, and they're only going to give capital, they're allocating capital where revenue generating opportunities are and where there's margin and profitability. They're not going to put resources into an area where there's no revenue or margin opportunity. So they are the chief risk officer. They're looking out for what is the sinkhole, where can we drop a couple of £100,000 for which there's no tangible revenue opportunity 1, 2, 3 years down the road. So that is the chief financial officer's role, to be the chief risk officer. So again, I come back to the relationship. You've got to have a relationship. You've got to understand what makes the chief financial officer tick, because they understand where the CEO is going and where the board wants the company to go. So it comes down to relationship, but understanding the risk is a big part of it. I had another opportunity, different client, who had sunk about £250,000 into an IT system that just was not going to generate any revenue opportunities. It was supposed to support the business, but we killed it after 18 months because it just wasn't doing what it needed to do for the business to support the growth. And the business is growing 20+% a year, but it just wasn't the right system. So we had to kill that. And so that's mitigating the risk that would have been a sinkhole and a cost to the business.
Great stuff. That's probably a good place to stop the show there, Rob. If you've been listening or watching this episode, I hope you found value from our discussion. In the next episode, Rob and I will be discussing how to build a marketing strategy that's aligned with investment goals. So stay tuned for that one. Rob, it's been a pleasure listening to you today. You've shared some absolutely brilliant insights there, and I hope the listeners and viewers have got some real good value out of that. So thank you again, and look forward to the next episode.
Thanks, Paul.